Good afternoon. I'm going to go over Chapter 1 just briefly. I'm going to try to flip through it pretty quickly. The reason for that, again, it's a review. You may or may not find this useful. Your only assignment, or not really an assignment, your only project, your only requirement, let's say for Chapter 1 is to complete the quiz. And again, it's kind of a review. There's some important stuff in this, and kind of go over that, hit some of the high points. It might have things to do with what we're going to do later on, but a good share of you could probably get by, without listening to this. But some of you probably just like my voice, and you just want to listen to it. Anyhow, let's get going and make it a little bit quicker. BPA, I put that up there as a reminder that we do have a Business Professionals of America chapter here on campus, and if you have any interest in participating in that, you should contact Lanny. He's the advisor for that, and they have gone on some amazing trips the last few years and have been very successful in national competitions. So something some of you might be interested in. Looks very good on the resume. So we got economics, right? You kind of maybe wondered why I had that economics comic there on the front page of the Brightspace, and that's kind of why. Economics and finance is kind of mixed, right? We got interest rates right now that have been on the increase for the last year from the Federal Reserve, right? That's economics, but boy, does that impact our finances and the financial decisions that CFOs or financial managers make, okay? Accounting provides this. I've always said I love accountants, but I hate accounting. I was never very good. I was okay at accounting, but I never enjoyed it, let's put it that way. But I love the results. I love to look at these things. Call me crazy, but to me that's kind of fun. It's like reading a map or something, I don't know. And so finance kind of links some of that economic theory and some of those economic projections and those types of things with accounting, right, to come up with some things. So an example of things that can happen, yes. And we're kind of in a little bit of that mode right now with people talking about a potential slowdown. We saw the stock market really dip in December, and a lot of that was maybe just based on things kind of like that. So in the 1900s, finance really emerged as kind of a separate field from economics and separate from accounting as well, right? So it revolves around some of these things, and these are definitely things we're going to go over. Capital preservation, that can be a key thing sometimes for businesses. We'll talk a lot about businesses that have too much capital, Apple maybe being one example. Liquidity maintenance. What's liquidity? It's the ability to have cash on hand to take care of all those needs that you have as a business, as an individual too, right? Okay, we're said to be liquid if we can pay our bills for the next 4 or 5 or 6 months. Okay, that's a good thing, and I would argue that it should be for a couple of years, right? Reorganization of financially troubled corporations. Boy, you want to read about Sears and going through bankruptcy right now, and man, oh man, might be kind of interesting, and that gets into the bankruptcy process. And they're proposing a Eddie Lampert, who's kind of runs Sears. He's the one that's kind of run it into the ground a little bit, but he wants to buy the company out. It's really interesting, but I'm not going to get into that at length. But if you have an interest, you should read some of the stuff about that. So in the 50s, it becomes more analytical. What happened in the 50s? We probably created more tools that allows us to be more analytical. Calculators, even the very, very, very beginnings of computing kind of, okay. Those types of things kind of came along that maybe allowed us to be a little bit more analytical. Modern issues, right? Risk return. Risk always goes, rates always go with risk, let's put it that way. The higher the rate, the higher the risk. If somebody's offering you a 20% return on your money, it's risky, period. Okay, rates right now are relatively low. I would expect somebody, if they're honest, they're going to be offering me a rate of 5, 6, 7%. Maybe I can't get anywhere near that at the bank, but in terms of an investment, with a mutual fund or something like that, on an annuity or something, that might be a reasonable expectation. If somebody's offering me 20%, it's too risky, I can tell already. Okay, maximizing return for a given risk level, certainly, and there are times when we do take on risk, and I'm not going to say that risk is bad. Companies do take on risk all the time. Individuals do too, and that can be good. You can maximize some of your returns based on that. A lot of that has to do with leverage, maybe borrowing money in order to move forward on those things. Portfolio management. So companies have, what's Apple do with all its excess cash? Yeah, I don't know. Well, maybe I do, but because you can read about it if you want to. But there's people that have to be in charge of that, right? And then the capital structure theory. How are you organizing your capital? And that's a debt to equity kind of a question. We'll talk about that. And that's changed. I think the dynamics of that have changed somewhat with the recent tax laws. The tax laws aren't covered in our book. It was printed prior to the tax law changes. And so, hopefully I can interject some things as the semester goes on that have to do with those tax law changes. New financial products with focus on hedging. Yeah, that's interesting. More hedging. If you read about Southwest Airlines, one of the things that's made them maybe more successful than some of the other airlines is their ability to hedge fuel pricing. Okay? When prices are low, they have a tendency to hedge, meaning going in the markets, and I'm not that familiar with probably buying a call, maybe it would be, on those fuels. Maybe they're buying a put. Anyhow, buying one of those financial products that kind of locks in their price then for fuel. So when the price goes up, they're kind of locked in. They get some money, coming back to them because they were willing to go out and hedge that in the marketplace. Okay? And more companies are doing that with different things. And then inflation. If you listen to the business news, you'll hear inflation come up quite a bit. And inflation's mild. Right now it's 1.5 to 2.5%. I lived in a time when inflation was 10 or 12 or 15%. A completely different world. Literally, I worked in retail when I went to college, and we were changing prices on items in that retail store weekly, moving them up because of inflation. That wasn't good. Okay, that was in the 70s. God, I'm telling you how old I am. Actually, that was in the early 80s, but it was just kind of getting under control then a little bit. Modern issues in finance. Again, this is continuing, I guess, and the effects of inflation or deflation. Okay, we can have that to a certain extent. We see deflation on certain products. They've actually become cheaper over time. Look at TVs. You can buy a 72-inch TV now for less money, and it's far better quality, easier to handle, on and on and on. You can hang it from your wall. Than 20 or 30 years ago, you'd pay for a console TV that was maybe 24 inches, was heavy, obnoxious, the picture wasn't that good, etc. There is some deflation that does happen. So. And required rates of return, that's kind of interesting. Cost of capital, we'll get into some of those things. Risk management in the financial crisis. So we went through the financial crisis. It was 2007, 2009, and that's long enough ago. You guys were kids. Most of you were kids and probably don't really recall maybe the angst that your parents had at that time. But it was an interesting time. I'll tell you, living through that was kind of interesting. But, yeah, there were certainly unwarranted extensions of credit. We saw subprime loans, okay? And subprime loans came from the creation or sale of mortgage-backed securities. So we had entities that were purchasing loans, and they were becoming more and more aggressive in purchasing those loans and encouraging the originators to actually originate loans that typically would not have been acceptable. But they'd buy them and they'd put them in these big packages, and everybody thought that was safe, and obviously it kind of went to hell in a handbasket. and losses. There was credit default swaps. That was a whole nother creature, and it was described to me as this. It'd be like you having the opportunity to buy insurance on your neighbor and then cut his brake line, type of a thing. It is kind of an oddball creature. So certainly we had the government action bail out certain companies. General Motors has been in the news a little bit. It was bailed out. Financial institutions were bailed out. Some of the bigger ones, Citibank, some of those. Some of them went broke. Lehman Brothers, for example. New regulations for financial institutions. Frank and Dodd. Oh, I guess they call it Dodd-Frank, but I still refer to it as Frank and Dodd. And I do that. A lot of my friends from my banking days, and I still maintain a lot of contacts there. They hate this just with a passion. It's put a damper on their ability to lend money, do things, serve customers, et cetera, et cetera. And so they really hate Dodd-Frank, unfortunately. Has it been good? Yeah. We're seeing some of the provisions they're backing away from a little bit with the current administration, so it's probably making life a little bit easier, but past and response. I don't know that we need to go through the details of this. I don't know that you'll have any detailed questions about this. You might have some. Some of the things that were important, there was a crossover between banking and non-banking institutions, and I know that's probably confusing if you haven't been in the industry, but a typical bank took in deposits and lent money. Okay. And there used to be a solid wall between that and non-banking functions. In other words, you were either a bank or you weren't a bank. And they broke that down. There used to be a law called Glass-Steagall, and they broke that down and kind of deregulated that 30 or 40 years ago. And they allowed banks to take on some of these other functions. And some of those maybe had to do with insurance, but a lot of them had to do with trading and whatnot in the marketplace, doing some of those things, equities and et cetera, that we'll talk a lot about. And what was happening is they were putting their depositors' money in jeopardy. And there wasn't a way to regulate the non-banking part of that. Banks have very, very strict regulations, right? But those regulations didn't apply to the non-banking functions, and it was all getting mixed up. And yeah, so this was a necessary change. Even my banking buddies don't really complain about that necessarily, because most of my banking buddies were in just banks, right? They didn't, small banks and regional banks and whatnot. They didn't venture into those other types of activities. The Volcker rule, yeah. This kind of went back to bring back a little bit of Glass-Steagall. It was the old Depression era rule, actually. Again, some things that certainly you read about certainly have had an impact. This is just amazing, and following Home for Lunch today and listening to the retailers, several of them that were just starting to report earnings, and they had a horrible Christmas. Macy's being at the top of the list, but Target and I can't remember who else was on there today. Well, what's the big reason? Amazon doesn't report for a little bit, other than reporting that Jeff Bezos is getting divorced. Okay, Jeff Bezos and his wife, I should say. Or Mackenzie Bezos and her husband. How's that, to be fair? So it's had a huge impact. I'm anxious to see those numbers because, if Amazon sales were way up, it's just this continuing trend of we're getting away from that buying at the retail outlets, the physical bricks and mortar stores, and doing more and more of it online. And you guys probably know that better than I. B2C is business to consumer. Products bought with credit cards. Even credit cards are getting to be bypassed a little bit. People are setting up the Apple Pay and doing those types of things, PayPal, etc. Right? Okay. Gosh, we used to actually write checks. You guys probably don't even hardly know what a check is anymore, right? Interesting how that money has changed and the use of money, etc. So. And B2B is business to business. And actually, more commerce, and this may have changed in the last few years, but up until at least a few years ago, B2B was a much bigger part of internet commerce than was B2C. Businesses were doing lots of internet stuff before you and I were buying lots of stuff from Amazon, if that makes any sense. They were making their orders and whatnot from wholesalers or from manufacturers. So, activities of financial management. Concerned with managing the entity's money. Well, yeah, and their income and their taxes and lots of other things, right? They allocate funds to current or fixed assets, and yeah. Okay. A lot of these are more based, though, on management decisions moving forward. Do we need fixed assets to do our job, and how do we go about doing it is kind of what the financial manager's job is, right? Obtain the best mix of financing alternatives. So do you borrow money to do that, or do you use cash on hand, right, if you have cash on hand? Dividend policy if in fact you're a corporation. There you go. Maximize shareholder wealth is always the main thing. Again, risk return trade-off. Forms of organization, and these are going to be important for your project one. So this is one area that I'll talk about that is kind of important. I'm going to quickly kind of hit the corporation, and I'll kind of skip a little bit the sole proprietorship, right? I think most of us understand that. It's a person doing business themselves. Okay. If no other real entity. Okay. Partnerships are two people. Okay. Articles of partnership, but keep in mind, not required. In the state of Montana, there's no requirement, at least for any formal documents for a partnership to be formed. Okay. A partnership can exist just when two people go out and do something together which they earn money at. Okay. It's technically a partnership. Okay. Corporations, and this was kind of the important one, especially for Project 1. Okay. Corporations are the only entities that pay taxes, right? Partnerships don't pay taxes. Sole proprietorships don't pay taxes. LLCs don't pay taxes. LLPs don't pay taxes. LPs don't pay taxes. Corporations pay taxes, okay? And only C corporations pay taxes, okay? Other entities can if they want to, but that's just seldom the case, okay? So, when you do your Project 1, that's important to note because most of you would not form a C corporation. Okay, and we talk about that a little bit later in the semester. We'll spend some time. I know we've talked about it in business law. For those of you that have taken business law, should be most of you. Okay, there's other advantages to being a corporation. Most of that has to do with obtaining capital. Okay, the ease of obtaining capital. You can sell stock. Right, so you sell stock and you obtain capital. Most of the big companies that we're familiar with that trade, say in the New York Stock Exchange, like Amazon, that's how they raised their initial money, was through selling stock, right? And probably had some bonds and whatnot too, but a lot of their equity anyhow was all raised through selling stock. Okay, they say that it's double taxed when we talk about a C corporation. And why do we call it double taxed? Because the corporation pays a tax, and then anytime it pays a dividend, or if a person holds the stock and sells it for a profit later, those profits, either the dividend or the capital gains, are taxed to the owner. Okay, so technically, C corporations at least are double taxed. An S corporation is treated more like an LLC or something, and the profits or losses flow through to the owners. I'm not going to talk too much about that. I don't think we need to talk a lot about Sarbanes-Oxley. I'm not sure that that's even in your quiz. Goals of financial management: maximize profit, maximize shareholder wealth. It's interesting. This would not be the goal for Amazon, for example. I like to use them as an example. They've been in the news a lot for other reasons, but they actually don't maximize their profit. Okay, and the reason for that is that they have been investing all their money back into the company. And so Amazon, if you guys look at Amazon, they have not shown a lot of profit. Recently, they've shown more than in the past, but typically they've been kind of a break-even type of a company, despite despite that, or if you've read the news about Jeff and Mackenzie Bezos, they're worth like $130 billion. That's the confidence that the market has in this company because of the revenues and whatnot that they've generated. That once they stop, if they chose to stop investing back into the company, they would show huge gains or net income, on a year-to-year basis. So maximization of profit then isn't necessarily always our goal, but increasing shareholder wealth. If you had bought Amazon stock years ago, you'd be much wealthier today than you were then. Okay, and so that becomes, I think, a more important goal, and sometimes that involves then investing money back in. There you go. There's the broader goal. Only way to retain power. Stock options. We'll talk about stock options a little bit. Yeah. Valuation. You'll hear about value investors, and that's kind of what we're going to do in Project 2 a little bit. But value investors, they analyze a company's financials and they try to determine when the market is inappropriately valuing that company, valuing it too cheaply, and so they can step in and buy it and make more money over time because of that. Okay? The other types of investors are typically called, now I'm going to fumble for the word. Heck. They invest on trends and charts and those types of things. Maybe the word will come to me as I go along. That's what happens when you get old and semi-retired. So, social responsibility and whatnot. We're not going to spend a lot of time on that. I don't know that that's what we need for finance class. Insider trading's interesting. There's been a lot of cool cases regarding insider trading. If you want to go read about some of those, feel free. Again, I don't know that has a lot to do with our financing, our finance class. So. Rule of financial markets, yeah, and this is important. The financial markets, not just the equities, which are the common stocks that you and I can buy or sell, but also the bond markets, okay, government bond markets. Those types of things are all extremely important, right? In what financial managers do, what they watch, and what they pay attention to, et cetera, et cetera. So really important, studying, understanding a little bit of like the public financial markets, which would be public government types of bonds and whatnot that are out there, treasuries, those types of things, GSEs, and then corporate financial markets, again, equities and debt, right? We can lend companies money directly. Distinct parts of financial markets. There's domestic and international, certainly. Okay, we probably won't spend a lot of time on international markets. We might talk a little bit about currency conversion and some things like that. Certainly not into any detail. Those might be things more for master's level type of a finance class, and not an undergraduate level. Corporate and government markets. We'll talk about these a little bit, and money and capital markets. Certainly, we will talk about. Money markets, right? They deal with short-term securities, short-term paper sold by corporations, certificates of deposit that banks might issue. Okay. Capital markets are longer term. Okay. Equities kind of have a perpetual life. Companies buy those back, and they do get retired or shelved, you might say. Okay, but they also include capital markets. Also include then most bonds that corporations might issue, because most of those are going to be longer term, 5-year, 10-year, 20-year, 30-year, those types of things. So, primary market is when a company initially goes out and raises money. I'm trying to think of recent ones that have been in there. Snap was about a year or so ago. And it was a fairly good sized one, and I'm not sure how it's done lately. I haven't really followed it, and I haven't seen too much about it in the news. Okay. But a company goes out and initially raises money. That's called the primary market. The secondary market is then when you or I maybe buy or sell those equities, okay, amongst each other. This could also be the primary market. It could be when they issue bonds. So it could be an older company. It could be a company that's been around for 100 years that sells bonds, okay. But there are new issues of bonds, so that could be called the primary market. But then, you know, I might buy that bond, and 5 years later I might sell it to you or somebody else, and that becomes the secondary market in that case. Like new cars from dealers and used cars for whoever, right? And we want to maximize our return, minimize our risk. But we have to be willing oftentimes to take on a certain amount of risk. And hopefully as we kind of analyze some companies and take a look at some of those things, you know, debt to equity ratios and how debt leverage, you know, can be an important component of that for increasing things like ROE. You know, I'll talk a lot about ROE and how using debt to increase ROE can be a huge factor. Restructuring, a lot of this stuff going on. Again, you know, Sears, gosh, they've been trying to restructure and do things, and you know, we're seeing that with some other companies now. Macy's is maybe going to go through that kind of restructuring. Who knows? Internationalization. Interesting stuff. We won't spend a ton of time on that. You know, might talk a little bit about some of that. I think it's really important, don't get me wrong. But again, I think to do an in-depth study of that, I think it's a little higher level than what we're doing for this undergrad. Cost reduction and trading securities. I see that some companies are getting together maybe, and they're going to allow the trading of securities outside of the normal. In other words, you wouldn't necessarily have to go through the New York Stock Exchange or the NASDAQ to trade securities. You could do that right within the company itself. Kind of interesting concept, right? There you go. That's just a quick down and dirty. I don't know how long I took. 27 minutes, not too bad. So if that helped, great. I would advise you as we go forward, though, what's going to be more important is probably my little videos that have to do with the problems that you're going to have to do. In fact, I probably won't do chapter videos. This will be the exception until we get to the very end. So thanks. Have a good day, and guess stay liquid.